Hey, welcome back. Vale is among the top iron miners on the planet, with operations especially in Brazil. Plus, they are the largest nickel producer on the planet and also mine some copper as well, both of which have a lot of potential in the long term. Vale is a very good example of a commodity company. When the price of iron was high, they were making even 20 billion in a year, the dividend was very high, massive buybacks and so on. However, during the lower part of the cycle, they can make around 3 to 5 billion per year, and even if they are profitable, the stock can easily crash to half of what it is today or even less. They are investing a bit more than usual, and in the long term, the average that they make during a cycle should go up. They have one of the lowest costs of production and some of the best iron mines on the planet, but there is also a downside to mining in these jurisdictions, as you're about to see in a bit. They have current assets of 18.7 billion, which cover the current liabilities. Overall, they are fine from a financial point of view, but we can see a lot of decharacterization liabilities, provisions and stuff like that, but more on that in a bit. Keep in mind, however, and this is something we've seen a lot recently, that if the price of iron falls, the value of the assets, especially the inventories, can also fall, but even then I don't think this would be such a big issue. They have a dividend policy where they try to pay 30% of EBITDA minus the current investments, which so far in good years has been very significant. Unlike other commodity companies that pay a certain amount like ADM, which I think is terrible, this is ideal because commodities are cyclical. This way they don't have to go into debt to pay you a dividend in bad times, and they use whatever they need to invest. They also bought back a massive amount of shares during the good times, which wasn't really the cheapest price, but they also contributed to the stock going up. This is good because you know that if the company is doing well, you get rewarded, making this even more attractive when the price is low, because then you can get some extremely high dividends in good years. Now, as with any mining company out there is risk of dam failures, lawsuits and other environmental issues. Vale actually has quite a few things to worry about from this point of view. You saw the decharacterization liabilities a bit earlier, and this is going to cost a lot in the long term. This is mandatory in Brazil and there is no way to dodge it, so you know that it's coming. Also, Vale and BHP face a couple of massive, and I mean very big lawsuits related to a dam failure from about a decade ago. Sure, they won't have to pay everything at once, but even a 20 billion fine on top of all the already existing environmental liabilities can eat a significant amount of money. This has the potential to basically nullify the company's growth or even result in negative growth for a while. Now, iron, probably more than almost any other commodity, depends a lot on China because the country represents a huge chunk of the demand. The country accounts for about 70% of the demand for iron ore. Even if Vale didn't have some of the largest ore carriers on the planet just to be able to compete with Australian miners in sending iron to China, the country would have still had a massive impact. So, the price of iron will, for the foreseeable future, depend on China, meaning that Vale will indirectly be affected by the Chinese economy, which can be both a good and a negative thing. Anyway, they are able to produce at a very cheap price, so even if there are some big issues that lead to the price of iron crashing, Vale would probably still make a profit. But the stock, on the other hand, would likely follow the price of iron, opening a very interesting opportunity. So if there is a recession globally or even just in China, this can easily fall quite a lot, and in such a scenario, the market wouldn't be rational. You can see how the stock reacted to the previous crisis, and this is completely normal for such a commodity company. So the higher the margin of safety, the better, especially in this case. I really like the package of commodities that they offer. You know, slow and steady growth from iron that can support the dividend, and very attractive and cheap production of copper and nickel, which I believe are two of the most important metals of the future. That's because currently they play a vital role in everything related to EVs and electrification and similar trends. As for a valuation, let's look into 3 scenarios to get an idea about how Vale could perform throughout the cycle. During the lower part of the cycle or during a recession, with higher capex and maybe even some fine, lowering it even further, they would still probably make a couple billion depending on how big the fine is. I'd say that a fair value in this scenario would be something like 20 billion, meaning a price of around 4.65. However, the market wouldn't be rational. In such a scenario, they can easily crash even 70–80% as they did before. If this scenario happens, they'd probably have to cut the dividend and buybacks completely, but again, I'm assuming that there is a fine. Without it, they could probably pay a 2, 3, 4% dividend. In a second scenario, during the average part of the cycle, they can produce around 10 billion per year. If the market is trading them at only 6 times that amount, which is pretty much average, that's a market cap of 60 billion for a price of around 13.94. That's a 10-15% profit plus a 4 to even 6% dividend. Now, during the upper side of the cycle, they can even make 20 billion. For a ratio of 6 again, that's a market cap of 120 billion, meaning a price of 27.88. That's currently more than a 2x plus even 20% dividends from the current price and massive buybacks. And this is why I want to buy this in the first scenario, because if I can get this for 5 or 6 and it goes to 25 in a good scenario, I 4 or 5x my money and I get a dividend that can basically cover my investment. And keep in mind that all the values that I mentioned in each scenario should slowly increase in the long term as the company develops, plus inflation and stuff like that. So again, my target would be something around 6 because that would allow for a very nice potential and the margin of safety should be pretty good. I think the current price is also fine, but not the risk and reward I'm looking for from such an investment. Overall, I think this one has much more potential than Rio Tinto, which I analyzed recently, but there is also more risk. The financials are good, the dividend can be attractive if I buy when the price is low, and overall the company is fine. This is a classic commodity stock that, in my opinion, should be bought when the price of iron is as low as possible. That's because the downside is very deep, but the upside potential, if bought during that time, can be even a 10-bagger plus massive dividends. So again, not a buy for me at the moment, but it's on my watch list in case there is a significant drop. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.